Northwest Paperboard Company, a paper and allied products manufacturer, was seeking to gain a foothold in Canada. Toward that end, the company bought 40% of the outstanding common shares of Vancouver Timber and Milling, Inc. on January 2, 2018 for $400 million. At the date of purchase, the book value of Vancouver's net assets was $775 million. The book value and fair values for all balance sheet items were the same, except for inventory and plant facilities. The fair value exceeded book value by $5 million for inventory and $20 million for plant facilities. So fair value of Vancouver's balance sheet asset will be $775 plus $25. The estimated useful life for the plant facilities is 16 years. Inventory was sold during 2018. Reported net income $140 million for the year ended 2018, and Vancouver paid cash dividends $30 million to all its shareholders, and Northwest is only one of its many shareholders. Prepare all appropriate journal entries. First, record the entry related to the purchase. When we purchase, we have an investment in Vancouver. That's an asset, so we debit. The payment was $400 million, so we debit $400 million. And they pay cash, so we credit cash for $400 million. And the journal entry for net income of $140 million. This target company will increase the target company's book value, because this net income will flow into retained earnings on the balance sheet. But Northwest only owns 40% of it, so 40% of 140 is $56 million. This investment will be increased by $56 million. And net income will be a revenue to the investor company, the parent company. So we credit investment revenue for 40% of the net income. And then they receive dividends from Vancouver company. $30 million of cash dividends were distributed to all investors. Northwest only has 40% of ownership of the investee companies, so they should only receive 40% of $30 million. So cash debited by $12 million. The distribution of dividends reduces retained earnings of the target company, the investee company. Therefore, the overall value of this investment is also decreased. So we credit investment in Vancouver by $12 million. And then inventory were all sold in 2018. All inventory were sold in 2018. Inventory is not depreciable. The difference between fair value and book value of the inventory is $5 million. So 40% of this difference needs to be adjusted. Inventory is sold, that means there is an expense called cost of goods sold on target company's income statement. So 40% of $5 million, $2 million will be an expense, but as a parent company, the investor will reverse the investment revenue instead of recording an expense. So we debit investment revenue. Oops, not interest, invest by $2 million and reduce the value of this investment by $2 million. Finally, the plant assets, plant facilities has a difference in fair value and book value for $20 million. So 40% of this $20 million is $0.5 million. This $500,000 of difference should be depreciated for the remaining useful life of these facilities, because the facility stops depreciating from the perspective of parent company's balance sheet, because the balance sheet represents the fair value at the point of purchasing the investee company, the target company. Once it's purchased, we don't see the increase or decrease of fair value of the target company. So after the purchase, the adjustment for the difference between fair value and book value should be reflected on investor's company balance sheet. Okay, so the $20 million of difference multiplied by 40% is the share parent company should adjust. That is $0.5 million and $8 million, and $8 million divided by 16 remaining useful life is $0.5 million. So there should be a depreciation expense, but the parent company cannot record depreciation expense. So we will reverse the investment revenue by $0.5 million and reduce the investment value by $0.5 million. I noticed that I selected the wrong account here. It should be investment revenue, not interest revenue. So let's go back to journal entry number 2. Change it to investment revenue. So now that's the correct answer. Okay. And the second and the third requirement says income statement amount. So let's go back to journal entries to see investment revenue. Credit 56 here, and then debit 2 here. So 56 minus 2, and then minus 0.5. Therefore, income statement has $53.5 million. And the balance sheet account, well, is referring to investment account. Debit 400 plus 56, and then minus 12, and then minus 2, and then minus 0.5. So we should have a balance of investment account on balance sheet for $1.5 million. And then the statement of cash flow, operating cash flow, go back to the journal entry. The cash related transaction is this one, $412 million here. The dividends received is considered as operating cash flow, and the amount to pay to buy an investment is called investment cash flow. So we have dividends income for $12 million, that's an inflow, and investing $400 million to buy the company's shares is an outflow.